So there is one account that I do believe that each and every South African should be utilizing and basically taking a full advantage of, and that is because of just how beautifully this account has been set up. And when you get to fully understand how it's structured and how to use it, you can turn a mere 500,000 into millions, and that millions will all be yours to come into your bank and to enjoy. Now, what am I speaking about? I'm speaking about a tax-free account. I've posted videos on my short form platforms, both Instagram and TikTok, speaking about this, and I got a lot of questions that I feel like I do want to make sure that I address on this video because they do need to be broken down in detail. And I did pick up that there's a lot of confusion when it comes to this account. There's also a lot of misconceptions, and lastly, people tend to end up using this account in the wrong way. So on this video, we're just going to be looking at those details, and do know that the information that I'm going to be sharing with you today, I did not suck it out of my thumb. I did get it from the SARS website, and I would encourage you to make sure that you also visit the SARS website so that you can learn about these things, especially when it comes to taxes. Always make sure that you consult the SARS website so that you can understand, instead of making your own assumptions and the wrong assumptions about things. Go directly to the source and get that information. That way, it will allow you to move much freer when it comes to your finances and manage your finances even better. But before we get into this video, let me first introduce myself. My name is Jennifer Ngomalo. I'm a content creator as well as a businesswoman. I'm currently self-employed, and I do create financial, career, as well as lifestyle content on this platform. So if any of those things are things that interest you too, make sure that you join us by clicking that red subscribe button on the bottom, and also don't forget to smash that like button. That is if you enjoy my content, because it does show support to my channel. Now let us get into it. Okay, so I said we're speaking about a tax-free account. I've made many videos in the past. I've made maybe a couple videos in the past breaking down a tax-free account and how it works, but I do want to just break it down even further on this video in terms of just clearing some of the misconceptions or maybe some of the questions that you may have. If you still have questions, do make sure that you drop them down on the comment section below. Maybe I will respond to those, or maybe we can even create a video further, or maybe a free workshop where we actually look further into this. But I think with this video, it will answer a lot of your questions. So the first thing is, a tax-free account was created as a way to encourage South Africans to save. There was a concern that a lot of South Africans are not saving, and as a person just sitting here looking at that, I'm thinking there are many reasons as to why maybe South Africans were struggling to save and still struggling to save. Maybe it could be the fact that they can't afford it, which how much they can get paid and the things that they have to spend on, there's little left for them to save. It can also be that people are also concerned about the taxes. When it comes to the taxes, I've seen a lot of misconceptions that people are worried that if I save, now I'm going to have to pay SARS taxes, and I do not want to do that, and so people will choose not to save. And also some people will also choose not to save or invest because they're worried about the safety of their money. So it could be a lot of things, but this account was created as a way to say, we actually have your back. We actually do care about you, and we have put this account for your benefits. Now, this type of an account has been existing in many parts of the world, and I do believe that South Africa did draw inspiration from those countries that had such accounts and actually implemented here. So this account has really been created for your benefits. And how is it created for your benefits? It's created for your benefit because it is a tax-free account, meaning that the money that you contribute here and the interest that you make over time, you do not have to pay taxes on it. Now, there's already a thing called a tax exemption that says that if you make a certain amount of interest per year on your investments or savings, we're going to exempt this much money on taxes. If it's beyond this, then you will have to pay taxes on it. So you do have to know about that. Go to SARS and you can read about that. But this account is saying, overall, however money that you make from this account, we are not going to tax you at all. We're not going to touch it. We're not going to do anything. It's going to be yours. So what is in there is what's going to come into your pocket to fully enjoy. That is how you benefit from this account. Now, how is it structured? Because that is also just as important for you to know. This is structured in a way that they are saying you have an allowance of 36,000 for you to be able to contribute into this account. This does not include interest earned from the money that you have contributed, but rather the money that you take from your own pocket. So you've earned a salary, and then now you are transferring this money into your tax-free account. The contributions that you can make into this account, the money that you can transfer into this account, it can go up to 36,000 only per year. It must not go over that. If you do end up contributing that, then there will be penalties. We'll speak about that shortly. And then per lifetime, these 36,000 can all be added up to 500,000. So if you keep contributing each and every year, or every time you do have money and you contribute and it comes up to 500,000, then you are done. It means you stop. This is what I don't want you to get confused. Yes, you can contribute 36,000 and then you can earn an interest on that. And maybe the interest takes your account maybe up to 38,000 or takes your account maybe to 45,000. That is the interest you have earned from that money, right? From that contribution that you made that year. That addition, that money that is an addition because of the interest that you have earned, is not taxed. That is your interest. You will not be penalized for that. What they're saying is we'll only penalize you if you take money from your own pocket and it gets beyond to 36,000. Now, these are things that I need you to know when it comes to this account so that you fully use it in a way that it's supposed to serve you. Firstly, let's understand this. This 36,000 is per year. Per tax year. How you measure this? SARS says that tax year is from 1st of March until the 28th of February or 29th of February. So you have that time frame for you to be able to fully exhaust the 36,000. Now, let's say it happens that you did not fully exhaust the 36,000 and maybe you are left with 6,000 that you still had to put in. And you got to 28th February and then we started March of the new financial year. It means that you have forfeited that 6,000. You will no longer be contributing that. You have to start the new year with the new 36,000. But if it happens that in that year you did not contribute anything at all, you did not put money into your tax-free account, it does not mean that you forfeit the 36,000 for that year. No, because a tax-free account is not calculated per years but rather per amount. So the moment that you put money into this account, then SARS will start noting that, okay, she has started contributing money into this account. Let's see how far she goes. So what this financial institution that you have this account with, what they do is that they report to SARS, how much money have you utilized? How much money have you contributed? How much interest have you gotten? And if you also gotten paid dividends from this. So what I'm saying here is, if let's say the previous year you contributed and then the following year you did not touch your tax-free account, and then you the following year, so you jumped a year and then there's another year where you started contributing. That year that you did not contribute does not mean that you forfeit the 36,000 of that year, because you did not start putting money for that year. But the moment you say the year starts and you put in money during the year, then they count that as, okay, you've started utilizing your 36,000 for the year, and if you finish it, you finish it. If you end up not putting all of the 36,000, then you forfeit the amount. I hope that makes sense. If you've got a question, please leave it on the comment section. Now let's talk about penalties. Let's say, for instance, you did put in 36,000 and then during the year you withdrew from this, especially people who invest or people who don't understand that this is supposed to be used for long term. So you put in money here, you kept withdrawing, putting money back in, and then you ended up contributing more than 36,000. Maybe you ended up contributing 45,000 or maybe 55,000. Mainly because you did not understand that once you put in money here, you can't just withdraw. If you put in money here, they start counting. You put money again, you start counting. If you withdraw, it doesn't mean that now the 36,000 will go down. No, yes, technically it will go down, but according to the records, you have utilized the 36,000. So if you ended up contributing 55,000, whether that 55,000 is in that account or not, but you have contributed more than 50 or more, you've contributed 55,000 into this account, this is what will happen. Now we're looking at the penalties now. SARS will deduct 36,000 from the 55,000. You'll be left with 19,000, right? 55,000 minus 36,000, you're left with 19,000. Now the penalty fee is 40%. So they will say 19,000 times 40%. And it will give them, when you calculate that, that gives you about 7,600. You will have to pay 7,600 to SARS in terms of penalties, which will come in the form of taxes for that financial year. So to understand the severity of this thing. So this is basically saying, do not put in money, withdraw money, put in money, withdraw money, put in money, because it will become difficult for you to track if you've utilized the whole 36,000. Just focus on putting in money and leaving that money to grow and making sure that you're sticking to the rules. If you don't stick to the rules, then SARS will penalize you, and they will penalize you heavily. Now imagine paying about 7,000 back to SARS because you decided to contribute more. You want to make sure that you stick to these guidelines that they have provided so that you fully benefit from this, and also you do not end up being a victim of unnecessary tax because you just did not understand how something is supposed to be used. Now let's look at the accounts that qualify as tax-free accounts, because not every account is a tax-free account. Not every savings account is a tax-free account. Institutions that do apply for this and get approved to actually offer this. You don't just offer it, you apply and you get an approval to actually offer this. But now let's look at the accounts that qualify to actually be considered as a tax-free account. First one is a fixed deposit. So if it's just a normal savings account, that's not a tax-free account. So a fixed deposit can qualify to be a tax-free account, but not every fixed deposit is a tax-free account. Just because you went to Capitec and then you put in a 7-day notice, or Standard Bank, whatever bank that you use, and you say 7-day notice, 32-day next notice, or you fixed it for a certain period of time, does not automatically mean that it's a tax-free account. It has to specifically say that it's a tax-free account, but then it must be fixed. It must be fixed. It must not be money that you can just get anytime that you want, like the likes of Abo Stash. I would say, honestly, when it comes to this, stay away from Stash, because Stash automatically offer their tax-free account, but then it's not fixed, and you can access it anytime, which makes it dangerous because you're going to end up putting more and you will end up attracting penalties. So things like Stash, just stay away from those. Unit trust, you can find them on TFSA. Other policies like AMA endowment, you can find them on a TFSA. But these, I would also say, just stay away from these because they do come with hefty fees, which will eat on your money. You want to make sure that as much as you are not going to be taxed on this, you also don't want to be attracting a lot of fees from this. And then exchange traded funds, my favorite, and that is because it's a form of buying shares, but you're not buying individual stocks, but rather you are buying a basket, or basically you are buying a fund that is in the JSE market. And then there's also the limited investment products that can be part of a TFSA. So these are the only things that you can find a TFSA on. And also another thing that I do want to bring up to you is that the moment you open a TFSA account, it is recorded, it is reported to SARS. Like for an instance, when I file my taxes, it picks up that I've got 3 TFSA accounts. I know that I did once open Stash and I utilized Stash at some point in my life. So I do know that counts. I also do have it with EasyQuities. That's the second one. The third one, I honestly do not know. I keep asking myself, what is the third tax-free account that I've ever opened? I do not know. So it's always better to just know which tax-free accounts do you have open. And also it's always better to just utilize one. Spreading your money in different tax-free accounts does not give you any further benefits. It honestly just, it doesn't make it. There's no benefit in doing that. There's no benefits. Let me just say that. I want us to talk about how do you now turn 500,000 into millions? How is that even possible? Because some of you may be asking, I don't see that happening. It is possible, and how does it happen? This depends on the type of TFSA that you get. As I said, there are different accounts that qualify for a tax-free account, and then there are also different institutions that offer you these types of accounts. There is the traditional way where you go through the route of the banks. Then there's another way where you go the route of investments. When you go the route of banks will offer you a product whereby it's just an account, but it's a TFSA account that come with an interest attached to it, and you find that this interest will vary. Now I'm going to tell you banks and in terms of the interest rates they offer into this account. Now ABSA offers 8.7% if you open a TFSA with them. Discovery offers 7.2.5%. Nedbank offers 7%. Standard Bank offers 7.3%. Investec offers 8.11%, and then African Bank offers 8.67%. Now, if you go with any of these products and you stick to the rules, you put in the 36,000 and you don't withdraw, you leave it to sit there for more than 15 years. Like if you actually put it to about 20 years, 15 to 20 years, you will definitely come out with $1 million, especially if you go with the one that have higher interest rate. You can get $1 million out of that. If you invest for that period of time and you leave your money to grow and compound, you will definitely do get over $1 million from that. Where that magic happens, where the magic happens is where there is no limit when it comes to the interest rate that you get to earn on your money, and that is through investing and investing only. What I love about it is that it opens doors for you in a way that you do not, there is no cap in terms of how much interest you can make from that. It can keep going based on just how good the market is going. And on top of that, there's also the compound interest. The best way I would say to use your tax-free account is for investing. With the banks, yes, I understand what they're offering, and also traditionally that is what they would offer. But I wouldn't utilize my TFSA for savings, because anything that the bank gives me in terms of this is the interest that is set, it's not an investment, it's rather a saving. Now, how can you go about that? It's when you put in your money in an account that allows you to buy shares. So let's say, for instance, you go to EasyEquities and you open your TFSA, you are able to buy shares with your money that you have contributed in your TFSA. With your tax-free account, you can buy shares, but just not all types of shares. You can't buy stocks with TFSA. You can't buy Capitec, you can't buy Woolworths, you can't buy Apple, you can't buy Tesla individually. However, you can buy things such as REITs, you can buy things such as unit trust, you can buy exchange traded funds where it's index that tracks those companies in the stock market. So you can buy those. Now, the beauty about the ETFs is that they are, like, let's say, for instance, S&P 500, it's top 500 companies that are being tracked in the JSE market. So what you want to do is you want to make sure that you understand what are the best performing ETFs in the JSE market, or basically right now, and you want to focus more on buying those. Don't just randomly buy ETFs, and I think I did that when I started investing. I'll just buy random ETFs, buy ETFs. Don't do that. Rather, make sure that you do your research and get an understanding of what are the best performing ETFs, and then you buy those ones with your money. That way you give your money a better opportunity at actually doing the work for you and actually yielding the results that you desire when it comes to the growth of your money. So some of the best performing ETFs are the ones that I've spoken about in my previous video: the S&P 500, Nasdaq, Nvidia, One Invest S&P Infotech. Another one is the 10x Total World Trader, the Cetrix MSCI World is also doing well. But you can do your research on these and actually buy those. I would really say that if you want to come out of this fund after 15 to 20 years with over 2 million, rather go the route of investing than to save. If you go the route of saving, you will get to $1 million, but then it will not be a lot of money. But also, this does also depend on when do you start. So if you are in varsity right now and moment you get into work, you also begin your journey of investing, you have far greater chance of actually having a lot of money out on this. You can open a TFSA account for your child. Let's say, for instance, the moment your child is born, you start actually contributing on this, and you're making sure that you're putting in 36,000 per year. By the time, let's say, for instance, your child is 21, they will be sitting with millions and millions, and they are more likely to be sitting with over 4 million when it comes to earnings on this, but not in a savings account, not when we're speaking of the ones that are offered by a bank where they cap you in terms of the interest that you get to earn. But if you invest this and you invest it right, by the time your child turns 21, 25, 30, you have set them up so well, because they will be sitting with millions and millions that will be theirs. Now, the point of this video was to really just break down some of these things that I found them to be as questions from these platforms that I posted these videos on, because these are things that people were just confused about. And I thought, you know what, let me actually turn this into a long video and just answer some of this, because some of you may be having these questions, especially when it comes to penalties, also how much you get to contribute. 36,000 does not mean that you only put once off. You can put once off, but also you can break it down per month and work up to the 36,000, so long as you make sure that you are doing that within the period that is specified by SARS, which is the tax year, which is the 1st of March up until the 28th of February or the 29th of February. So that is the crux of a tax-free account, you guys. I really just do want to encourage you that do utilize this, but don't just utilize this anyhow. If you are not ready or you are not clear about how to utilize this, rather just not start, you know. But if you are clear about, okay, I understand how this works and how I can benefit from this, really utilize this. And I will add this. This is a perfect product for you to use as a retirement plan. Remember that your retirement annuity gets taxed. Your pension fund get taxed. But when it comes to this, it doesn't get taxed. So you can utilize this. Best way to utilize it is for retirement purposes. But for short-term savings, please don't do that. For medium-term savings, don't utilize a tax-free account. Utilize a tax-free account when you know that you are ready for long-term and you are honestly content with that. Now, there was one of the questions that was concerned about safety, to say, but now is it safe to sit with so much money into a bank account? In this world that we're living in right now, no one is safe. We're not safe. Our resources are not safe. Our assets are not safe. Even ourselves, we are not safe, you know. So there is nothing that is really safe. But now, if you want a chance to wealth, if you want a chance to living a life in your own terms and actually letting your money work for you, you do have to throw away safety out of the window, you know, but also making sure that you're doing everything right. You want to make sure that you are firstly going with a reputable institution that is regulated. You want to make sure that you are ticking these boxes as you are going about your investments and savings, because that's at least your way of making sure that you're putting that layer of safety. But now, in terms of, is it safe for you to be having so much money? How you have to throw that out of the window. And if you are not willing to throw that out of the window, then you will never really be wealthy. Let's be honest. You will never really be wealthy. I'll make you an example. Right now, we have issues with the pension fund. As you know, I worked in the public sector. So right now, we have issues with the pension fund where there was a certain interest that was charged on people's accounts, where a person would have been sitting with hundreds and hundreds of thousands, but then they went in and took away money from people's account, and they called that an interest of some sort. And I also don't understand it. It actually frustrates me when I hear such things. And this is actually a thing that they did, where they went on people's account and they took money from this. And then they said it's people that retired before a certain age and so forth. That just shows you that even if the money is in the government hands, it's still not safe. It just shows you that when it comes to safety, when it comes to investing and saving, you have to throw that out of the window and understand that anything can happen and anything will happen. And be ready for anything happening. Yes, when that thing happens, it won't be nice. But then let's say nothing happens and actually everything works out. You will be sitting on the side wealthier. But if you sit in your corner being scared to invest and start and saving because you are worried about the safety of your funds, then you'll never get to the other side of being wealthy. You will never. The wealthy keep getting wealthier because they are willing to take risk. And they are aggressive with their risk. But then we keep on struggling. The middle class keeps struggling because why? We are not willing to take risk. We are scared of taking risk. So I'm bringing this point of pension, which if a government can go into people's pension and take away about 100,000, 200,000, that cannot be fully explained in terms of where they went to, Imagine now if you say, I don't want to have pension because I don't know what government will do with it. Imagine now when you say, I don't want to invest because I don't know what will happen. Anything can happen and anything will likely happen, but you have to be able to withstand the risk of that. That's why they always say, don't have all of your eggs in one basket. Now, people that only have pension funds right now, that have only been contributing to pension funds, that had no investments on the side, have nothing on the side, will be crying foul because all of their eggs were in one basket. They were just relying on this one thing. So you want to learn to diversify your resources. As much as you may have a retirement annuity that you have been building up, build up another nest egg some way. Buy whatever, maybe you buy property and so forth. But do not just rely on one thing and say, okay, with this thing, I'm good, I'm set. Don't do that, because anything will happen and anything can happen. That is about it when it comes to this video. I really just want to close it. I really don't want this video to be too long, and I just wanted to hit the points that are important. But as I said, if you've got questions, make sure that you leave them down on the comment section below. I'll try my best to respond to them. But also do visit the SARS website, guys. Please don't be lazy to read. Sometimes you post something, you explain something, you even respond on some comments, but then the person will still ask one and the same thing that has been responded to on the video or has been responded to on the comment section, just because the person did not feel like reading what is there or watching the entire video. So please do not be lazy. Don't be lazy when it comes to these things. Go and read for yourself and get an understanding. Let's say, for instance, you have read, but now you don't understand. Rather be asking based on what you have read, and then for you to be ignorant and not go on the right sources to learn and then go asking people, you end up getting the wrong information. With that being said, I'm going to close it off right here. Thank you so much for tuning in and watching this video. I truly appreciate it. If you did enjoy this video, please make sure that you give it a thumbs up. I really appreciate that. I'll see you on the next one. Please take care and stay safe. Bye.